When it comes to building wealth, two investments dominate the conversation: real estate and stocks. Both promise financial freedom, but which one actually delivers the bigger returns? The answer isn't as simple as you might think. It requires understanding the real math behind each strategy. If you're serious about making money and building lasting wealth, hit that subscribe button, because we're breaking down exactly what the numbers actually tell us. Let's start with real estate, because it's the investment most people think they understand. A house feels tangible. You can walk through it, live in it, and point to it as an asset. That psychological comfort is real, and it drives millions of people to the real estate market every single year. But comfort isn't the same as returns. When you buy a house, you're typically putting down 20 to 30% of the purchase price and borrowing the rest from a bank. Let's use a concrete example. You purchase a $300,000 property with a $60,000 down payment. That means you're controlling a $300,000 asset with just $60,000 of your own money. That's a 5-to-1 leverage ratio, and it's incredibly powerful. Your bank is essentially financing 90% of your investment. Now, let's say that property appreciates at 3% per year, which is a historical average for residential real estate. In year one, your property gains $9,000 in value. That's a 15% return on your initial $60,000 investment. The bank's money grew your wealth significantly because of leverage. But here's what most people forget to calculate: the costs. Property taxes, insurance, maintenance, utilities if you're renting it out, and potentially vacancy periods if it's a rental. These expenses can easily total 8 to 12% of your property's value every single year. That 3% appreciation suddenly doesn't look so impressive when you're paying 10% in annual costs. Then there's the transaction cost. When you buy or sell a property, you're paying real estate agent commissions, closing costs, and legal fees. That's typically 5 to 10% of the sale price gone immediately. If you buy a $300,000 house and sell it 10 years later for $390,000, you've made $90,000 in appreciation. But after paying 6% in selling costs, you've netted only $39,000 in actual profit. The leverage that excited you at the beginning suddenly feels less impressive. Let's contrast this with the stock market. When you buy stocks, you're not using leverage. You pay the full price with your own money. There's no bank finance in your investment. You buy $1,000 of an index fund, and you own $1,000 of index funds. But stocks have their own advantages that people often overlook. Historically, the stock market has returned about 10% per year on average over long periods. That's higher than real estate appreciation. More importantly, there are virtually no ongoing costs. You don't pay property taxes on your stocks. You don't need to maintain them. You don't have vacancy periods. An index fund that costs you $175 might charge you only 0.3% in annual fees. That's 50 cents per year on that $175 investment. But here's where it gets really interesting. Let's compare actual dollars over time. Imagine you take that same $60,000 and invest it in the stock market instead of real estate. At a 10% annual return with minimal fees, after 10 years you have $155,000. Now compare that to the real estate scenario. After 10 years, the property appreciated from $300,000 to $420,000, but you paid property taxes, insurance, maintenance, and other costs totaling about $120,000. Your net gain was just $90,000 before transaction costs. After you sell and pay that 6% commission, you're left with $84,000 in actual profit on your $60,000 initial investment. The stock market scenario netted you $95,000 in profit. That's $11,000 more than real estate, and you didn't have to deal with tenant disputes, roof repairs, or property inspections. You also didn't have your capital completely illiquid. You can sell stocks in seconds. Selling real estate takes weeks or months. Now, let's talk about what real estate does better. Real estate forces you to save. When you have a mortgage, you're forced to make a payment every single month. That discipline is powerful. Many people lack the willpower to invest regularly in stocks, so real estate's mandatory payment structure becomes an advantage. Additionally, real estate gives you leverage without the risk that comes with margin trading. You control a $300,000 asset with $60,000, but if the market crashes, you're not getting a margin call. You simply stay in the property. Real estate also generates tangible income through rental payments. If you rent that $300,000 property for $1,500 per month, That's $18,000 per year in gross income. Stocks don't generate income the same way unless you buy dividend stocks, and dividend yields are typically only 2 to 3% annually. The psychological satisfaction of receiving a rent payment is also significant. People feel like they're building something. But here's the critical insight that changes everything. Real estate and stocks aren't actually as different as people think when you optimize each one correctly. Real estate investors should be minimizing costs and maximizing appreciation in high-growth markets. Stock investors should be reinvesting dividends and adding to their positions regularly. Both strategies compound wealth over decades. But the math strongly favors stocks when you account for all costs and consider the time you spend managing either investment. Let me give you the real comparison that matters. If you have $100,000 to invest and you're asking which makes more money, the answer is almost certainly stocks, but only if you're comparing apples to apples. $100,000 in a diversified stock index fund will likely outperform a $100,000 down payment on a property when you factor in all costs. The stock investment requires no active management, generates no unexpected expenses, and offers complete liquidity. However, if you're using leverage on the stock side, say by buying stocks with margin, you introduce risk that matches real estate leverage. Most people don't have the discipline for that, which is why real estate can actually outperform for the average person. The forced savings mechanism and the difficulty of selling in a panic make real estate a better wealth builder for people who lack investment discipline. The real winner isn't real estate or stocks. It's starting early, staying consistent, and avoiding huge mistakes. If you start investing at 25 and consistently add money for 40 years, you're going to be wealthy regardless of which vehicle you choose. The person who invests $1,000 per month in index funds at 25 is going to accumulate far more wealth by 65 than the person who waits until 35 to buy their first property. If you found this analysis valuable, hit that like button. It takes just 1 second, and it tells our algorithm that you want more content like this. Now I want to hear from you. Are you leaning toward real estate or stocks for your wealth building? And what's actually holding you back from taking action on either one? Drop your thoughts in the comments below. I read every single comment, and your answer might just inspire tomorrow's video. Thanks for watching, and if you haven't subscribed yet, please do. We're releasing new wealth building insights every single week, and you don't want to miss what's coming next.